it is a largely lower start for all of the Asian markets. Actually, all of them are in the red, with the Nikkei suffering the biggest blow in opening trade.
No losses will be, and this is an important point, no losses will be borne by the taxpayers.
Inherently, 6.44 is a bad number for CPI, and it compares with 6.29%, which was the CNBC TV 18 poll.
Absolutely quiet, so that's the first take.
While we are amongst the flows, and the industry has been once again seeing some recovery.
The bad news is that we are not in a bear market, so we could head into one, but I don't think we're heading into one.
When it comes to any kind of insecurity about banks, there's no upside to taking chances.
We have many irons in the fire, as they say, based on our strategy for geographic diversity.
The Nifty is once again gravitated to the day's low, 17,075 points, 0.5% lower on the benchmark indices.
Sources tell CNBC TV 18 that the Bandhan Group is exploring opportunities to enter the insurance market.
The food index is up 0.1% on the month. So my sense is the culprit is going to be milk yet again, and maybe even cereals.
Well, it's turning out to be a session where we are seeing some amount of declines, but there's definitely a recovery.
Hello and welcome to a fresh new edition of Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Rima and Surabhi. Guys, hi.
Hi. Afternoon, Rima. Afternoon, Prashant.
Well, I think the two big questions are, right, is there going to be another shoe to drop? And what's the Fed going to do? Pause or continue with its rate hiking, right?
Somebody catches that shoe, right?
We thought they did. The US government did. The market's still not convinced.
Yeah, it's, by the way, we broke 17,000, right? We're in the midst of the second bounce back for the day. So the points will come up on your screen. We broke kind of hit just under the 70,000 mark, and now we're about 50 points above that level. The first low was made at 12 p.m. We got a 100-point bounce back till about 12:30 p.m. From 12:30, there was a straight sell-off all the way to about 2:30. I mean, right as we were starting the show, we got to just under 17,000, and there is a 50-point bounce back. That is a chart which kind of clearly shows what's happening. The one thing which is very evident, has been evident from the morning, is that bounces are getting sold very easily, without a problem, right? I mean, hot knife through butter. Very easy, sort of sharp, swift 50-60 point sell-offs, just like that. That's never a good thing. All sectors are in the red. Top losers, of course, are banks once again. It's basically a mix of both local and global worries. In terms of the global worries, it's, of course, banks. But there is also the US CPI number later today, which has faded in importance massively as compared to bank worries. But, I mean, the only thing is, if you get a very strong consumer price inflation number in the US, it puts everything into a conundrum once again. Because then you've got a situation where markets priced out all rate hikes by the Fed, you get a very hot inflation number, and you got a central bank which cannot hike rates to fight inflation. It can't do more aggressive QT as well, quantitative tightening as well. And that potentially could be dollar negative. But this is very near term. The point is, dollar is essentially an asset which climbs when there is risk aversion. So if on the back of all of that there is risk aversion, the dollar again can't be that weak as well. So it's a bit of a flux right now. We'll see the number as it comes through later. US futures in Europe are trading higher, but I think as we saw yesterday, that is only kind of mild consolation, because those things can turn very sharply. But for now, it is, things are under pressure, about 100 points lower on the Nifty. Rima.
And we're down for the fourth day in a row now. And the Nifty fall started from levels of 17,750 last week. And now it's extended its decline to almost, 700, 750 points thereabout, as the Nifty is closer to that 17,000 handle. Across the board, there's a fair amount of bloodbath. The Nifty Pharma index is now at a fresh 52-week low. Individual IT names like HCL Tech, Emphasis are now trading at 52-week lows. Adani Enterprises has a 10% knock, and a couple of these financials. So Indian Bank, Bank of India in the PSU banking space, big cut seen there. PNB Housing Finance too, showing a cut of close to about 8.5%. So a lot of uncertainty, panic, fear, and no one really knows, right, how this is going to play out.
Oh, yes, absolutely. I think the saving grace for the bulls is that there's been some attempt at some bottom fishing in a couple of the frontline banking names. you still have the odd ICICI and an IndusInd, which is on the top side of the screen. And maybe that's where the bounces are coming in. But as Prashant mentioned, they're also getting sold into. The broader markets are feeling the pain. There's no doubt about that. And if you pull up the advanced decline lines, far and far wide apart. I mean, just about 760 stocks advancing. You have well over 2,100 stocks on the declining side. So that's the shape of the mid-cap market. Absolutely no convincing bottom fishing. And even some of the commentary that's coming in, I think, at least what I've been hearing, a lot of sort of market participants also saying, let's wait and watch, keep the powder dry, be on the sidelines. Yet to hear a view which is saying, you know, all guns blazing, let's go all in and buy this dip. So I think the uncertainty is simply weighing on people's minds.
Absolutely, Surabhi. There's no compelling reason, right, to go and buy as well. Is there a big compelling reason to sell everything? Absolutely not. I don't think that is the case as well. But I think we've been talking about, you know, a lot of people are asking, if it is not the US, why is the market selling off the way it is? The only, I mean, the only way to look at this is perhaps there's no reason for an intensive sell-off. But even before this, markets were not as if they were roaring. They were generally weak. We did a piece, I mean, if you remember, right after the first quarter earnings season, the third quarter earnings season, beg your pardon, which said that 60% of BSE 200 companies, and this includes Nifty 50 and another 150 top companies, 60% of that group has seen earnings downgrades. And then we put out a list of companies which have seen significant earnings downgrades, right? So, I mean, there is the PE hit from the global worries, sentiment, which impacts, I guess, PE, and the earnings impact here locally as well. So, I mean, there's no compelling reason to kind of go in and say, well, this is it, this is the level I want to go in a very aggressive way.
Absolutely. And just one more point, I think I was looking at the FI numbers as well. So up until now, half of March, we came into positive territory. January and February were negative months. Up till March, we're positive to the extent of about 11,700. This is the final data from the depositories. And I guess there's also concern, I mean, if the sell-off continues to be so aggressive internationally, then, you know, will we get into that mode of FII selling again? And again, looking at domestic institutions to offset the impact. So I guess, that adds to
I'll probably be proved wrong in 2 days flat, but I want to make not a prediction. Prediction is not, but it's a prediction.
Please go for it.
Go ahead.
I think we'll forget about this US bank thing maybe in a week more. You know, it doesn't feel like this is.
There's a contagion.
It's a contagion. It doesn't feel like.
Doesn't feel like 2008.
We've seen 2008, 2007.
But you know, just on that point of 2008, what someone told me is that the first time Bear Stearns, one of those two funds, gave any red signal was in February or March. I think March or April. And after that, April. And then Lehman collapsed only in September, right? So these things take time to spread and play out.
I take your point, but
so I'm just,
which is one caveat, Reman. I said, right, reserve the right to be wrong.
Of course.
But I think back then, no one knew what was subprime. I did not know what was subprime.
Exactly. Yeah.
We were fine. But this is, I think it's a different kind of situation. So we know what they're at least talking about the risks in the system. It's kind of not well understood, but it's there. It's not a new thing coming out and hitting us in the face saying, well, this is something completely new.
And, we have the benefit of hindsight, right? As it turned out, that was just human greed at play. Mortgage-backed securities, what was going on, asset quality. There was so much going on back then. This is maybe mismanagement of, sharp interest rate increases.
That and also the fact that the three banks which have collapsed right now had a very concentrated holding, right? Yeah. All the tech companies flocked into SVB. They were the ones who raised money, which is why they had a deluge of deposits, which went into their banks in 2021. And they're the ones who didn't manage to raise money whole of last year. They need money now to withdraw, to pay their salaries. So they're asking, right? So no other bank has such a concentrated holding of only tech. And the other two, of course, were crypto-focused banks. So, as Neelkant put it, I think, in his call today, that these banks had an idiosyncratic element to it, right? The fact that they were so concentrated. So I guess that's the other caveat that we would like to put on board. But we've got a lot of questions for our viewers. So let's kickstart the show by talking about the market technicals. 17,000, we flirted with 17,000, skirted with it, but didn't quite break it convincingly. Mitesh Thakkar is with us now of earningswave.com. Mitesh, this decline is now extended for the fourth day in a row now. How much more do you reckon?
So, good afternoon. One, I think, the index looks very oversold to me on the parameters, but there's no sign of a reversal as yet. And I think Prashant was just, highlighting this question as to when would you want to buy this. I think the only way you want to do it is wait for some kind of an intraday, hourly, 2-hourly chart giving you signals of reversal. You might go wrong maybe 1 or 2 times, but then the post reversal, the initial phase gives you a very good risk reward entry point. So even if you lose very less. But if the reversal comes out nicely and it will come out someday, then I think you make a lot of money. So I think that's the way to approach it. I think we have cut our short position because of the oversold levels, not now trading on the short side, because my target holds around 17,069.70 in the minimum, and we got a low of around 69.87. And now I think, let's see if 69.50 gives away, and then we'll take a fresh shot. Otherwise, a pullback to about 17,250, 300 is the zone where I want to short again. So waiting it out in that sense. On stock side also, I've tried to identify stocks which are trying to turn the leaf and giving some kind of reversal signals. Again, the markets are choppy, so I think, taking right stop losses is always a tricky thing. But I think these are 2 stocks on my radar which are showing some signs of positive traction on the hourly and the 2-hourly charts and the intraday charts. So I have Deepak Nitrate as one of the recommendations. The stock is trading in positive. The hourly charts are very good. Recommend a buy here with a very tight stop at about 1809, which is just below 1810 pivot level, and look for targets for around 1865, 1870 to begin with. And the other one is NMDs. Again, the stock is already turned positive, just giving some reversal on the intraday chart. That's a buy with a stop at about 114.5 for targets of 121.
All right, got that, Mitesh. Thanks for the call right now. We'll come back to you and take stock of the market in another half an hour. But for the time being, let's just, before we get to our next guest, talk about the IT space as a whole. And Rima, I know you've been talking to a lot of people on the street just to get some handle on what this entire implosion of SVB and some of the other financials in the US, what it means for Indian IT companies, because they're highly exposed to the US markets. What are you picking up?
Well, so the fear in the market is that US banks are under pressure, and US banks are the largest sectoral contributor to Indian IT companies. Now, Indian IT companies derive about 30 to 35% of their revenues from US banks, and the market is worried that these US banks are under pressure, which could impact growth rates in India. Now, bear in mind that right now it's only the regional banks where there is some fear, and the large US banks like JP Morgan, Wells Fargo, etc. These are the big clients of the Indian IT large caps like the TCSs and the Infosys of the world. The pressure is on the regional banks, and it's the mid-cap IT companies which have an exposure to the regional bank. So here I want to talk about just 2 of them. One is Coforge. They have an exposure to a bank called Fifth Third Bank, and Fifth Third Bank shares were down 13.5% yesterday. And Mphasis has exposure to First Republic Bank, a share price of which was down 61-62% yesterday. Remember, it's not that there is a run on any of these 2 banks, but there is fear on these regional banks, and mid-cap IT companies, some of them have some exposure to these banks. So that's the worry in the market, which is leading to a sell-off today. But even if there is no contagion impact, what the street fears is that banks on the whole are going to get cautious. They may go into capital conservation mode, which means they may not go ahead with their tech spend, or tech budgets may get delayed. Sales cycles could get longer, which then clouds the IT services, revenue visibility. So that could be the base case scenario now for, from a market point of view. Even though there may not be any implosions which directly impact any of the Indian IT companies, there could be some slowdown. Deepak, do you want to comment on any of these mid-cap IT companies like Mphasis, Coforge? If you do have any holding, what should investors do?
Yeah, good afternoon, Rima, and thank you for having me on your show. I think you put it really well that, right now there is no fear about any cancellation of contracts or any further days for furlough, but certainly the sentiment in the US banking sector is going to be morose, and that's going to affect at least new projects which these IT companies may have to start, or entire process of decision-making process will get elongated. So you are going to have to deal with that kind of uncertainty, and Coforge was a fantastic outperformer. Last 2-3 quarters delivered industry-leading growth rates. They've been very aggressive when it comes to getting new contracts and new projects. But if a big client like this were to put a pause, then certainly the growth rates may get affected. So I think given the situation, one should be a bit cautious as far as entire IT pack is concerned. And I think maybe the time to sell is not is perhaps gone, but at least one should not take fresh investments in any of the IT companies at this point of time. And this could, deepen even further, as we have seen back in 2008. One doesn't really know. And in somewhat, we are in uncharted territory. So best is to just wait and watch and see how this evolves.
Yeah, Deepan, hi, good afternoon. Broadly, otherwise, what's your view, though? I mean, still cautious, Deepan? And just wait in the sidelines?
Good afternoon, Prashant. Yeah, good afternoon, Prashant. See, I was just thinking that, while I was listening to your commentary before the show started, just after the show started, that fundamentally, actually, nothing has changed. I mean, corporate earnings, whatever they are, they are. After the last earnings seasons, we have seen some upgrades, some downgrades, and we're very clear which sectors are doing well and where the stress is. But yet the market has corrected from those levels, and we've gone down, frankly, below the 200-day moving average. And although I don't follow technicals so much, but some of the key points, I think, like breaking of the 200-day moving average is a cause for concern, as well as the fact that the entire pattern is of lower tops, lower bottoms. It's very clear and evident. And in a situation like this, however bullish you are on the stock market, and you may have a lot of stock ideas to invest in as well, but maybe from timing perspective, you just need to wait and watch. And it's very difficult always to catch the bottom. But still, I think the risk reward doesn't really favor you. So it's better to just wait out these trying times and look for investing once you have the first signs that the markets have reversed and the technicals have improved, FIFOs have started coming in, some of the broader issues like Adani Group stocks and all those issues have got perhaps resolved. And there is some visibility as far as US banking system is concerned. I mean, we're asking for a lot at this point of time, but right now, I think as I see the screen, I would like to just wait and watch and be cautious.
All right, Deepan, stay on. We have more questions coming up for you, but we do have to take a quick break before that. On the other side, we'll also be joined by our Alpha Manager of the day, Aman Chauhan of Abacus Asset Management will join in. We'll figure out how they are negotiating this market fall.
Welcome back. 17,030 on the Nifty, 122 points lower. The Sensex down 300 points. Europe right now at least is holding up with minor green ticks. So just gains of about 0.2, 0.3% on the key indices over there. So just keep the global markets and the indices and the rates there on your watch list. But let's talk about another important corporate story. We learned from sources that Bandhan Group is looking to enter the insurance business. Yash is joining in. Yash, what are you picking up?
Well, that's correct, Rima. So the insurance regulator time and again has been talking about adding more companies into the sector, and what we've been given to understand from our sources is that one of those new companies could come from the house of Bandhan Group. What sources tell CNBC TV 18 is that Bandhan Group is exploring entry into both life and general insurance market. The first objective or the first move is expected to come towards the general insurance market, post which life insurance market could also be looked at. Now, in this context, according to our sources, Bandhan Group management also met the insurance regulatory body expressing the intention to enter the insurance market. And also what was discussed according to our sources in this meeting is that the group is looking at both options, the organic as well as the inorganic route. As far as the inorganic route is concerned, here what we've been given to understand is that the group is already in talks with some of the existing general insurance companies, possibly looking at an acquisition opportunity. Also, as far as the organic route is concerned, the group is awaiting the insurance amendments which are waiting for the parliament approval. Once that comes in, that hopefully will reduce the capital commitment which the group will have to make to enter the insurance market through the organic route. So, of course, the group as of now is present in the banking sector, in the mutual fund space. This will be an important addition to that portfolio in the form of insurance company.
All right, got that. Thanks very much, Yash, for the details there. So we'll watch out for Bandhan and their next plans. Deepan, that brings me to a wider question on financials. Actually, give us a call on Bandhan in specific if you do track the stock. But even otherwise, I mean, just look at the way large cap, mid cap, all kinds of bank stocks and NBFCs have been sold in the last two sessions. Would you nibble into anything right now, or would you stay on the sidelines?
See, I think that, as I said earlier, I want to stay on the sideline at this point of time and assess how the situation is going to play out. And the sell-off which we are seeing in banks, I think it's more towards the global trend. I have noticed this in the past that when tech stocks sell off in US, then we have a similar sell-off in our software companies, and the same is true for metals and commodity stocks, and now to an extent even banking stocks. If overall globally bank stocks are being pounded, then bank stocks in India also are under pressure. And that's more to do with the high level of FI ownership in the Indian banks, especially the private sector banks. So as I said, I think nothing has changed fundamentally for the banking sector. It's just that there's a risk of trade, and that's impacting stock prices. Coming to Bandhan, I think it's been a big disappointment. They have destroyed a lot of value over the last several years or so because of poor lending practices. And microfinance was supposed to be a hot sector, and a lot of investors got drawn into it. But the way the events have played out for Bandhan Bank in terms of the NPAs and the credit losses which they've had to bear certainly has dampened the sentiment for Bandhan Bank, and the price to book, price to earnings multiple when it got listed and what it is trading at just now is a huge discount. So they may want to get into a lot of businesses like insurance, mutual fund. At the end of the day, I think the basic banking business is not going as per what the street and we have been expecting. So we'd like to remain completely underweight or nil weight as far as Bandhan Bank is concerned.
All right. Devan, stay with us. Sona BLW is the other one. This is surging in trade on the back of a bullish CLSA note. Sonia is here with more details on what CLSA is saying. Sonia, over to you.
Well, thanks a lot for that. Just to put it into context, yesterday Blackstone exited Sona BLW completely by selling their remainder stake for over 4,000 crores. Now, that caused a little bit of jitters, right, as to why Blackstone is exiting Sona BLW, and is that a concern in terms of what the way forward would look like? But I did put out a piece where we mentioned that the business for Sona BLW is very strong and the growth outlook is pretty good. In fact, this morning as well, CLSA put out a note where they said that the stock's recent decline is due to some concerns over the continuity of the management post Blackstone's exit. However, Blackstone's exit has not changed their thesis. So just to put the numbers into perspective, it's been a very strong business. As of Q3, the quarter gone by, the company reported its highest ever revenue, EBITDA, as well as profitability. And the margins are also likely to increase going forward, says CLSA, because of a better product mix. Now, if you look at it, the financials over the last 5 years have been very strong for Sona BLW. It's been a 34% compounded growth rate on the revenues for the last 5 years. The EBITDA has seen a very strong growth as well. And now over 60% of the order book for Sona BLW comes from the electric vehicle space. So electrification is the big theme both globally and locally, and Sona BLW is a big beneficiary of that. Hence, after Blackstone's exit, there was a little bit of a downtake, but now the stock has recovered in considerably from its lows yesterday. Back to you.
Dipan, do you like Sona BLW?
Yeah, I think it's a great company. It's just that it's very expensive when you compare to some of the other auto ancillary companies. And no doubt, I think it's got a bulging order book position because it's a key supplier for many EVs. But a lot of the positives have got captured in the stock price. But we do like the auto ancillary space, and usual disclosure, we and our clients will be invested. We like company like Uno Minda, which came out with very good set of numbers and is present in many, I would say, sub-assemblies and assemblies within the passenger vehicle, the two-wheeler industry. And its growth rate has been quite impressive. And valuations also are reasonable. And there'll be some other such companies as well. But by and large, I think Sona BLW, great business, but as I said, quite expensive.
All right. Thanks very much, Deepan. Great speaking with you, and appreciate your time here on CNBC, as always. Thank you. Well, our alpha manager today is Aman Chauhan, and he's fund manager at Abacus Asset Management. He's joining us now to take some questions. Aman, great to have you with us here. Thank you very much for your time. What is the reading of Team Abacus with what's going on in the market, Aman? There's a bit of sort of fear in the system. People drawing parallels to past financial panic episodes. What can happen? We don't know the full thing. What's your own reading?
Too early to take a call because what happened in the past, I'm sure, is not going to get repeated in the same way. So if we draw parallels to 0708, we all have learned from the mistake of 0708. So I don't think that same event is going to unfold this time. it's going to be something different. And that is what the uncertainty is all about, as to what exactly is going to unfold, which is making the market numbers. Markets don't like uncertainty, and that's this exact situation we are in today. So we are in the same boat. It's uncertain times. That's the reason we have not taken any bold stance, either to get very aggressive in the market or to be completely defensive. So continuing with our stance, wherever we find a decent opportunity, we are deploying cash, irrespective of the sector, irrespective of the overall market mood. So clearly going up bottom up at the current juncture.
So where are you looking at these bottom-up bargains? I mean, I don't know if you can talk stocks, but otherwise, even in terms of just themes or ideas, what sort of stocks are you looking to pick?
So clearly, in the near term, we are not looking at companies which have an export focus, because we are also uncertain as to how the European and the US economy is going to shape up. Clearly, there is a slowdown there. What is uncertain is the extent of the slowdown, but I don't think anybody has a doubt that there's going to be a slowdown, or this slowdown is going to continue for some time. So that's a clear no-no. So domestic focused companies, inward looking companies is what we are focusing on, and sectors which will benefit out of the lower commodity prices. So say like cement, which will benefit from lower coal prices, or say some of the consumer needs which can benefit from lower palm oil prices, lower agri-products prices. So these are some of the sectors that we are focusing on. And banking, obviously, is something that is clearly inward focused, domestic growth-led sector. And that is something which we are continuing to be positive on.
Okay. Would you hold off on your purchases? I know you like a few stocks and you would buy them irrespective of the sector, market, levels, etc. But broadly, is this the time to invest whatever you have to invest in those stocks at these levels? Or do you think lower levels are in store for our markets, and therefore, if you want to invest 100 rupees in stock A, you would invest only 10% right now?
I would invest 20% right now, and I'll wait for the balance. So it's not going. There's no tearing hurry, because frankly, it's not that we have valuations which are like too comforting that there's no downside risk. From here on, also markets or stocks can indeed correct anywhere from 5, 10, 15%, right? So it's not that we are trading at low single digit or low double digit margins, P ratios. So I'm not cautious, but yeah, definitely no tearing hurry to deploy.
Yeah, no, that's well put, Aman. No tearing hurry, no big compelling reason that I have to lock in this price, right? It's well put. And of course, I mean, one is valuations. The other is that beyond this bank weakness episode and how that may pan out, the impact of accumulate the 500 basis points that rates have gone up in the Western world, I mean, that has yet to kind of show through in the economy, right? And that will lead to some growth hits everywhere.
Yes, so the initial impact is already visible, and going ahead, the full impact is going to be visible. But the market is aware of this. It's not that the market is going to be surprised seeing the impact of this 500 pips. It's more of a call as to how severe the damage is because of this rate hikes. Right? It's going to be a soft landing or a hard landing. That's what the market is trying to negotiate. An added element to this is that if there is a hard landing, then markets will be volatile in the near term. But the Fed will come in and either talk the market up, will say that no more rate hikes, will infuse some liquidity, and that is good news for equity markets. For the economy, it will still take time to get reflected, but the stock market will bounce back very sharply. And that's the dilemma managers like us face, that we can't be at the extreme side of being a buyer or being a seller, because even if there's a near-term volatility, it can happen that overnight US markets are up, overnight Fed makes a statement, Dow futures goes up, and tomorrow morning we can have a gap up or a gap down opening. So as I put in, it's uncertain times, and hence we are also feeling it pretty in a very neutral way, just staying put as to what we were doing a month or 2 months back, doing nothing great or nothing different as we speak.
We've already tasted what the impact of this 500 basis points rate hike in the US has been. Is there a possibility now of a very deep recession, a hard landing? Earlier, markets were contemplating with a soft landing, a technical recession. Do you think now
there was no landing.
No landing was also, one of, the scenarios. But do you think now there is a possibility of hard landing and growth rates will radically come off?
I'll say lower probability of that. But if that happens, then I expect the Fed to counter that in a very meaningful way. So it's not going to be too severe for too long. Even if that happens, it's going to be maybe 1 or 2 quarters before the Fed starts to step.
Okay, thank you very much for joining in. Let's get to our segment, D Street Chatter. Nimesh is here. He's going to get us an insight into dealing room chatter. Nimesh?
Hi, Rima. So, a weak-looking screen. In fact, the selling from yesterday continues even in today's trade. In fact, intraday we hit a low. I mean, we still be below 17,000 as well on the Nifty, and every pullback is getting sold into. So that's the overall theme for the markets today. While the flows are mixed, again the volumes are quite high in select bank stocks. That suggests there are two-way flows into the banking names, and I guess that contingent effect of global banks getting sold into is having an impact on the Indian markets as well. So that's playing out as far as the banks are concerned. The other sector which got punished today is the mid-cap IT. You explained as well the reasons why the mid-cap IT is under pressure. And even in terms of flows, I believe there is selling pressure in some select IT names, mid-cap IT names from the larger institutions. That's the overall feedback. I guess from a technical point of view, as I said yesterday as well, the first crucial level was 17,200. That got breached, and then we have seen selling pressure. So the next level to watch is 16,800 on the Nifty. If that's get taken out, then maybe you'll see a bit of a capitulation as well, not only in the large cap names, but in the mid cap and small cap as well. So that's the overall feedback. So 16,800 is a level to watch on the downside. But in terms of flows, while it's mixed, there is good amount of volumes in the bank stocks, and that's something to do with what's happening in the global markets as well.
Okay, so that's the overall market. Nimesh, what are you hearing on individual stocks, if anything? I know the chatter is mostly about the overall sentiment, but individual names?
So, sir, in terms of individual names, the first stock on my list today is PG Electroplast. Been consolidating for a goodish bit now, trading in that very narrow range. There is a very high chance that this company is likely to raise money via QIP very soon. In fact, the feedback is that maybe the roadshows have started as well for a possible QIP and fundraising. So that's the reason why that's the first stock on my list today. The second stock is IndusInd Bank. After a big sell-off yesterday, the stock was down 7%. Today is a bit of a relief rally as well. You're seeing a bit of a pullback. But even today, the feedback is that there is extended selling in IndusInd Bank from larger institutions. So, well, the street is divided on how to read this 2-year extension. But there is supply in IndusInd Bank even in today's trade. So that's the second one. The third stock is Aurobindo Pharma. Within the pharma names, this is the only stock where there is some bit of accumulation happening at these levels. And there is a constant feedback of some bit of buying back in this particular stock from larger institutions. So that stands out as far as Aurobindo Pharma is concerned. And the last stock is Reliance Industries. Within the large cap name, this is one stock which is showing a lot of weakness. And there is constant supply as well coming in from larger institutions in Reliance Industries. And hence that stock is under pressure for the last many days. And that's the case today as well.
Thank you very much for that. Need to get into a break. As we do that, a quick programming reminder. Today, CNBC TV 18 will host what will be India's largest summit on gender parity in Delhi. Women leaders from all walks of life will come together to brainstorm and ensure we take decisive steps to bridge gender inequality. The event starts at 4:30 p.m. We will bring you live coverage right here on CNBC TV 18.
Well, for what it's worth, it seems the Nifty will, try and go home at least above the 17,000 level. So let's bring in Mitesh back to ask what should the approach be. Mitesh, so tell us, the way today is different from the past couple of sessions is the volatility. It's not been very easy to trade this market. It's not been a one-way up or down. So your thoughts and final advice for the day.
So I think also, if you consider that in the last 4 days, we have fallen by about 780 points. One, going long, there's no evidence to do that. Two, going short, I think you are way off the stop loss levels or, pivot levels on the intraday charts or even moving averages. I think this is the time if you shorted for the last 3-4 days, maybe even yesterday morning, I think that's the time. This is the time to take profits and then wait to see how the market pans out. If we get a pullback, very good. Otherwise, we'll have to wait for 16,950 to be taken out before we take fresh shots. So that's the way we're approaching the index, and therefore, we don't have any current outstanding positions on the index right now, trading with some stock-specific biases. I have STVT on PFC, disclaimer, it's still a part of my long-term portfolio, but I think the intraday charts have turned slightly weak over here. So 162.25 is the stop loss. 155, 156, 156 half is the target zone. And earlier I had 2 buy calls, and now one more, attempting a short call post the PFC call. That's SBI cards. Here I would recommend the STVT with a stop at 732 for targets of 714.
Okay, all right, Mitesh, thank you very much. Appreciate you joining in, and thank you for running us through your views as always. There's 16 minutes to go for market closing, and the situation is, not vastly improved. It's not worsened as well. 100 points lower, 1755 on the index. Jay Bala is with us of cashthechaos.com. Jay, good to have you with us here. I think we missed our weekly appointment last week. I think it was a holiday, Tuesday,
Holi.
last holiday, right? Holi,
Holi.
yes. And I wasn't there either. But, how are things looking, Jay? We had a faint hint of a bounce, right? Towards the end of the week before last. And then, of course, we had issues starting Wednesday last week, which continued to this day. What's your sense on the index to begin with?
Hi, Prashant. Thanks for having me on the show. See, I had highlighted 2 weeks back that, the bounces are likely to be fleeting, and, maximum could be about 17,700, and the market went closer to 7,800. And it's no surprise that they have started going down the way and behaving the way it is. The price action is consistent with the expansionary phase for the market, and we are likely to see more red, not because it's going to be the Ides of March, but because it's consistent with the L8 wave pattern, which is we have entered the strongest middle portion of the pattern, which is the longest and the strongest. So we're going to see more red days for the markets, and so long as we are only seeing 1% down days, it's good for the market from a bearish perspective, because people are still not capitulating. So once we have the big red days, only then the probability of capitulation they appear. And the significant support for Nifty is at about 16,750. We have some intermediate support about 16,934, but I don't think that's going to hold. And the bounces are going to be even more temporary than what we saw last week. So we're going to see a continuation of what we've seen.
And so the Nifty is headed to levels of 16,750, and that's where we could find some intermediate bottom for our markets. What about the Nifty Bank?
See, the Nifty Bank has had a fresh breakdown yesterday, and it's been in a narrow range, and that range has broken down. I had highlighted 2 weeks ago that not to get misled by the fact that Bank Nifty hasn't broken the budget day low. It's just a deception, and market has once again proved exactly that. It trapped a lot of people into believing that the Bank Nifty is an outperformer, and right now we have got a break below the budget day low. And we have some big patterns shaping up for frontline banks like Kotak Bank, ICICI, and SBI. So we're going to see 37,000 in the near term, and much lower levels in the medium term.
So you're looking at lower levels on the Nifty Bank as well. Sorry, I missed the level. How much lower from here, would you say? Actually, both for the Nifty and the Bank Nifty, Jay?
Yeah, from the short term for Nifty, I'm expecting 16,750, and also probably that will also give way, and 16,400. But 16,750 will be a point of realization for a lot of people, because that's the September low. Some of the people would have already noticed the fact that market went below 17,255 and clocked lower low. That would have actually made them a little more uncomfortable. But 16,750 is a point of recognition, and the markets are going to go below that. But when it comes to the banking index, somewhere about 37,300 the next support, and that's where I think in the short term it's heading. In the medium term, I've pointed out that for both Nifty and Bank Nifty, they need to go close to the June 2022 low, and for the Nifty, it will probably break below that. The banking index need not break, but it can also break below that.
Okay, now come to the, we'll get back to other sectors, etc. But just a bit on global, right? Because that has been such a big driver. But one is not sure in what way is our global markets impacting us. I mean, so yields have fallen from, the 2-year has fallen from 5% last week to 4%. I think your view is, but no, you got a view on the 10-year, not the 2-year. So tell us, Jay, what's the put it comprehensively, what's your view? Global markets.
since we just crossed the Oscar season, like we can use a little bit of Hollywood reference. In Hollywood, they say gentlemen prefer blondes, but in the stock markets, gentlemen refer to the bonds. So the bond markets, people are of the opinion that Fed is going to pivot, and because of that, that's going to turn the market bullish. But if you refer to the last 50 years of history, the worst of the declines for the stock markets have always come after the Fed has pivoted. So, if people are placing hopes on that, it's a misconception. It's thoroughly misplaced. And the 10-year yields and the 2-year yields have given up some of their strength. But I think the 10-year yields is going to hold above 430 bips, and it's continued to go above the fresh 52-week highs. In the event that it were given, it doesn't change the medium-term picture. It just changes the short-term picture. So, bond markets are still saying, to my opinion, pointing to higher rates. So when it comes to the global equity markets, the Nasdaq, barring the Nasdaq, all the major indices in the US are trading below critical supports, and the outperforming European markets have registered a reversal signature. So we're going to get more pressure from the global equity markets.
Okay, if I could just try and find some optimism here, Prashant, if what Jay says plays out, bond yields are going higher, rates are going higher, that means the Fed keeps hiking, which at least means we don't have a banking crisis, right? So I don't know what's better or worse, but just try to pick the silver lining.
Said, let me use some Oscar reference. I thought he's going to take off after Natu Natu and sing something for us, Jay.
Yeah, I'm sure. Yeah, I'm sure Kiravani has come up with much better songs. It just caught the attention of the Hollywood folks there.
All right, should we let Jay go or should we make him sing? Should we let him go? Jay, thanks very much. It's always a pleasure. Great having you with us here. And it's a good chat, always. We'll, although it's not very good news, as telegraphed by Jay, things are looking quite weak. 100 points lower, 17,052 is where we're at. We take that break. We're back on the other side. More on markets. 9 minutes to go for close.
Welcome back. 100-point cut. That's how the day looks like. It'll probably wind down. I'm looking at some of the green specs on the screen. Titan is one of them. So I'm buying on an L&T and the banks. Mitesh, are you looking at any FMCG stocks at all? I mean, this is a very different sort of a correction. Typically, money gravitates to FMCG in times like these. That's not exactly what's happening right now. But your thoughts?
This is a start of a correction, and even the FMCG stocks are showing corrective signals. So, for example, we have earlier had trading sell calls on stocks like Godrej, Consumer, etc. But if you look at the long-term charts, Britannia and HUL have been, were the stocks which few months back were making fresh highs. I mean, them apart, the rest of the pack still looks very weak. To be Dow, America, etc. We'll possibly see some correction. So, if I was to look at, the reversal happening in the FMCG sector, I would look at some kind of uptrend starting in HUL or Britannia. Till that happens, I think, they might not actually go through a big correction, but they'll also be choppy and consolidated.
Okay, by the way, there are some spikes taking place in Adani Group names. Pull up Adani Green, that intraday chart. There's been a sudden spike. I think for a greater part of the day, the stock was down 4-5%, but now it's only down 0.1%. So Adani Green is, one of them. That intraday will come up for you on your screen. CG Power is another stock where you have seen a sudden up move in the stock. But finally, it looks like that 17,000 handle is going to hold. We breached below it. The intraday low on the Nifty was 16,989. So we went below that 17,000 mark, but we're managing to close above it.
Some bounce, right, from the lows. Like yesterday. Yesterday also we had a nice, almost a 70-80 point bounce from the lows, but it was negative. So we'll end with almost triple-digit losses once again. The big losses, of course, coming through today in the public sector banks, which were the top losing sector. IT lost, the IT services sector. Metals were down, and the real estate index was down and out as well in terms of trade. I was just looking at the broader market, and I'll not go into names, but advanced decline is negative, some 2:1, little over 2:1 in favor of declines. So there is, of course, all the Adani Group stocks which make which are there, but I can't find any large, well-owned institutionally well-owned stock there which is corrected in any large significant way. So numerically, it's 2.5, almost 2.5:1 in favor of declines. But it's not as bad for broader markets, at least. That's what I can see. Yes.
But there are so many mid-cap financials which have lost ground. So PNB Housing Finance, 10% down. Indian Bank, 8.3% down. Bandhan Bank plans to diversify. Bandhan Bank down 5.3%. Bank of India down 5.5%. So mid-cap banks took quite a knock today. Some of the other losers include in the frontline pack, IT names. So TCS led the losses with a cut of 2%, but others like Wipro, HCL Tech down between 1.5%. Wipro also losing ground. M&M was under pressure, a cut of about 3%. Some of the other large cap financial names. So Kotak Mahindra Bank weakening in trade. And HDFC Life. HDFC Life has today hit a fresh 52-week low. On the gaining side, Bharti Airtel stands out after it extends that entry-level tariff hike to the remaining circles. So now it's a pan-India increase. BPCL, one of the big movers, Titan also up in trade.
Yeah, actually, Yash was pointing out not just HDFC Life, pull up some of the others as well. ICICI Pru Life, ICICI Lombard. These are all insurance stocks and they are at the 52-week low, just absolutely there. SBI Life, LIC is very close to a 52-week low. So insurance as a space has been battered and bruised, and that's of course been in the making for a while. Let's look at some of the other names. On the brighter side of things, there's Sona BLW. After that cleanup trade from Blackstone, stocks up about 7%. Today's listing, Divgi Talk, in a market as challenging as this, it's managed to put on 3%, so it's not too bad on the new kid on the block. Then we were talking about more losers than gainers, obviously. PNB Housing Finance final cut is almost 10%. That's a crunching fall. Indian Bank, 8.5%. Bank of India. So PSU banks, tier 2 banks, PSU banks, that's where the cuts are really, really deep on the downside. On the upside, well, only one or two names really. Sequent Scientific has managed to buck the trend. Lemon Tree is a name that stands out. But then the list pretty much fizzles out over there. Overall, the mid-cap index has ended with a cut of about 0.5%, very similar to the Nifty. The saving grace for the bulls that, at least for today, we've managed to protect the 17,000 mark on the Nifty. And let's not lose sight of the fact that the Bank Nifty hasn't done as bad as the Nifty today. Last two sessions, it's really the Bank Nifty which has led the fall. But that trend at least kind of started sobering out today. We don't know if that continues or not, but I mean, just trying to clutch on straws here.
Okay, let's wrap up on Closing Bell. From the entire team, thank you for watching. Don't go anywhere. Markets Today comes up next.